Hi, this is Stephen Ertel with Consinity Financial. Thanks for joining me today for this presentation on the United States student loan debt debacle. So let's go ahead and get started. So let's first explore the significance of this issue. Current total student loan debt stands at roughly $1.3 trillion and has increased at a 16% annualized rate for the last 13 years, far outpacing GDP growth and inflation during that period. Total student loan debt now exceeds the annual GDP of Mexico. It's also the largest household debt category, excluding housing, larger than credit card debt, larger than auto loans, and it's the only household debt category that has an increasing delinquency rate. You couple these things with average student graduating with roughly 30,000 in debt, and these loans not being dischargeable except under very specific and rare circumstances. We really see this is a significant issue. Just have a chart here to illustrate that. We can really see the exponential runaway growth in student loan debt over this time period. And we actually see the red line here in 2008, following the financial crisis, we actually see a deleveraging on part of households, excluding student loan debt. So, we see absolutely no hesitation in student loan debt whatsoever during that period. Just who are these borrowers? I think that there's a tendency for most Americans to look at student loan debt as a young person's issue, but as this graph illustrates, those ages 30 to 49 actually represent half of the total outstanding student loan debt. And that same age group represents over half of those student loans that are in delinquency. And we note that these are loans in delinquency that are in repayment. This is important to note because as the federal government calculates it, the current delinquency rate is 15%, but that is of all borrowers, including those who aren't in repayment. However, we restrict those loans to only those in repayment. The actual delinquency rate jumps up to about 27%. So the actual delinquency rate far above kind of the headline rate published by the federal government. Now, we actually see the federal government as being the largest lender to these students. Their loan portfolio is over $1 trillion, issued through their various direct lending programs. Prior to 2007, when the federal government really took over the direct lending, Sallie Mae was securitizing private student loan debt into student loan asset-backed securities. These are really similar to mortgage-backed securities in that large institutions really saw these as near cash alternatives. However, since the financial crisis, this market has largely dried up, thus the Department of Education taking over through their direct lending. I think that student loan debt has been identified as a problem by the mainstream. The Obama administration has introduced various income-based repayment plans to try to alleviate this issue. What it really does is extend the terms of these loans from 10 or 15 years out into the 20 to 25 year range, and it caps payments at 15% of disposable income. If a person doesn't end up paying off their loan after that 20 or 25 year period, the unpaid balance is forgiven, but would be taxable as income. This is very well intentioned, and a second benefit is that it keeps loans out of repayment, so really holding down the official delinquency rate. However, as we illustrate in this slide, a few different scenarios for paying off a $30,000 loan balance. First is the standard repayment plan, straight line, $253 a month payment. After 15 years, they will have paid $21,644 in interest. But this is seen as too burdensome for the average college graduate. So let's explore one of the income-based repayment plan options. This accounting major went on to be very successful, and they paid off their loan balance in full in 20 years. However, if you notice, for the first 5 years, their loan balance actually increases to $40,000 because they were not able to make monthly payments. However, because they ended up with higher earnings later in their career, they were able to pay off their loan balance, paying in excess of $1,000 a month for the last 4 years. Total interest paid, once again, above $56,000. This would be seen as, kind of the successful case of an income-based repayment plan. The unsuccessful case, we have the untalented, well-intentioned art major, or we could substitute any four-year degree that doesn't substantially increase one's earnings potential over time. In this case, they were able to start making monthly payments after graduation, but because their earnings potential just never really materialized, they were never able to actually meet the interest obligation on the loan. So their loan balance increased to about $53,000. At year 25, this $53,000 balance would be forgiven, and they would be paying income tax on that forgiven amount. So we could see, in this case, they only pay $16,000 in interest over the life of the loan. This really illustrates, I think, what these income-based repayment plans incentivize is not making these monthly payments or incentivizing a lower income level to avoid having to pay these loans off. So let's look at what this means for investors going forward. The term student loan anvil has been coined. It describes this debt overhang for college graduates, really likely to affect consumption in future years. Couple that with baby boomers accounting for less and less spending as they age. This is going to leave a hole in consumption likely to go unfilled. We're in a highly leveraged economy. Continued growth here in the United States depends on increasing debt consumption. With consumers already debt laden, any rise in interest rates, as we're looking at the Fed normalizing interest rate policy here in the near future, this is going to have significant impacts on consumption. And we're looking at most likely slower economic growth for the foreseeable future, and marked by the continued boom and bust cycles as we've seen for about the last 15 years now. And now some tips for parents and students. When we plan for college education and for a future career, I really suggest consulting with a financial professional. It's important to look at college education from a cost-benefit standpoint, looking at the desired career path, future earnings power, and really making a financially sound decision on whether college is even the best option. If college is the best option, we need to look at potentially going to school part-time and working while we're going to school to limit the amount of debt that we need to take out. I highly suggest after the education is completed to begin making payments immediately to significantly reduce interest over the life of the loan. Also, paying highest interest rate loans first. And we need to look at consolidation if it's possible. There are a lot of ins and outs to these rules. Specific cases for each borrower. You might need to contact the lending agency who you're working with. Potentially you can lower your interest rate, and it really simplifies the paying down of the debt. And that sums up this presentation. On behalf of Nick Rossalillo and myself here at Consinity Financial, thanks for joining us. Here at Consinity Financial, we're a fee-only investment advisor. We don't work off of commissions. We're bound to a fiduciary standard. We really see client education and financial education as a big important part of our business, in that we really like to empower our clients to make financially sound decisions in everyday life. In regards to college education or student loan debt, we'd be happy to sit down with you or your student and really empower you, in this process. You're welcome to give me a call or send me an email if you have any questions, or visit on our website, consinityfinancial.com. Thank you.